So on the weekly time frame, we can see we have this fair value gap here. And this is internal range liquidity. Like I said before, external range liquidity has been taken. And then we saw a reversal pattern here, in which there was SMT divergence in 4-hour time frame against the dollar, the DXY, and then price rally downwards. So last week was a bearish week. So I'm expecting this week to tap into this fair value gap before running up to take this high and this high. So today is a Monday, so let's go down to daily time frame. So you can see this is Monday already printing, and it's reaching for this price imbalance. So when you see a gap like this, there is nothing printed, there's no full body. It's called price imbalance. So there's a likelihood that price might want to run to this point here before running down. I really don't want to see price run into this fair value gap, because if it begins to run into this fair value gap, and then probably maybe this fair value gap before running down, probability of price returning back to this high or finding support in this fair value gap is low. So let me say it again. If price run into this fair value gap before running down, probability of this fair value gap holding price to run higher will become low. So I either want it to come down, find support, rally, or just rally right away. So once price gets to this point, I look for my entry pattern to sell. So we can see this candle here. This is a breaker block. You can see how price took out this high before running down. So this candle here is a breaker block. So price might get to this point before finding resistance. This here, I've not taught this to any of you, but this is consequent encroachment. It's the, let me show you. It's the midpoint between this week. So if you draw your fib from this point, so that is the midpoint between the open of this candle and then the low of this candle. All right, so let's go down to 50-minute time frame. So we expect to see this as a protraction, and then there's a fair value gap here. There's a tiny fair value gap here. Now, before you enter the trade, what you want to do is you want to map out your take profits. Where are you planning on entering, and where are you planning on getting out? You can see this point here. This is what we call relatively equal lows, and it is a sell side liquidity. So we expect to sell around this area right here, take partials here, and then hopefully market will run to this weekly fair value gap. It might not happen today, it might happen tomorrow, which is Tuesday. Now from this high to this low, where is internal range liquidity? We have this high, we have this high, and then we have this fair value gap. But I'm going to take this off so that doesn't make the chart look clumsy. So it has taken out this highs and then this fair value gap. The last thing here is this order block, this bearish order block here. So I don't expect to see price go above this high. So if we draw your fib, we'll see that we're already beyond equilibrium and we're in a premium. So this is where you want to be selling. All right, so I guess you should log into my account and get ready for your sell. Now, mind you that things I'll point out, you should expect a protraction after 12 a.m. and you want to be selling above market open. So this line you see here represents market open. This line here represents market open. So let's go to a 1 minute time frame. Market is already above market open, so I'm looking forward to sell. So we're in the breakout already. Okay, we didn't get to the breakout, we are at the, all right, so I'm selling. I want to see price close below this fair value gap. All right, so we've gotten a close below this fair value gap. So I expect the candle with strong momentum to print anytime soon. So today is US bank holiday. It's a time I'll likely not trade. And again, today is a Monday. So these are double reasons why I shouldn't be trading today. But the euro is not on holiday. So I would like to just explain a few things with this trade. So I had to just take it. Remember, market is all about probabilities. That you lose a trade doesn't mean you don't know how to trade. You will have losses. But all you just have to do is know how to minimize your losses and maximize your profits. So let's see how today will play. This is momentum displacement, and the price return to this fair value gap. So if I was here, I would have been entering this return because price broke structure to the downside. So you took out liquidity, broke structure to the downside, and then found support in the fair value gap, which was created by this price displacement. Like I explained before in Q zones, I told you that London close is where you find the low of the day. Usually, the high, if it is a bearish day, you locate the low of the day. If it is a bullish day, you locate the high of the day. So let's go down to 5 minutes so you see it clearly. So you can see how last week Friday made the low of the day in the London close, and then the high of the day was formed in the London session. See how price reacted with this. Let me just draw it out. This is new day, this gap here. When you notice there's a gap like this, price tends to remember it. So how price bounced, then rallied through it, returned, found resistance, then rallied downwards, rallied, found resistance where in the New York session, then rallied downwards to form the low. Okay, you can see how market is reacting strongly. So let's go to Euro USD to see what's happening. Beautiful. Beautiful. So I want to see how price reacts here. I want to see price run through this gap with ease, and then if it returns, I might add to my position before running these lows. So it depends on what price does here that I determine my decision. Price has tapped into internal liquidity. Where's the next place price will go to? And today you are seeing this candle printing. You know that this day will likely be a bearish day. Why? It has formed this 3 candle pattern. You see this candle here today. Middle is higher than the candle left and right. So this swing high has been formed, and then it has filled in this fair value gap. So you expect this day to be bearish. If this day doesn't get bearish, expect the next day to be bearish. If it doesn't go bearish, you keep expecting the next day to run for this low. But you don't just go and sell blindly. There are things you look for in that day that will tell you that market wants to go bearish. So you use those things to refine your trade to sell. Then another thing again you should notice, this has formed a long-term high, short-term high. They were looking to see this as a short-term high. And if this low is broken, this becomes an intermediate-term high, and this becomes a long-term high, making it difficult for price to run to take this high. If price runs to take this high after breaking this low, then probability of this trade being profitable reduces. Same as saying the probability of market running down for this low, and then this low reduces. Because why? Intermediate term high has been taken. You don't want to see intermediate term high taken. You can see short term highs taken, but you don't want to see intermediate term highs taken or long term highs taken. So let's see. And why would this become an intermediate term high? Because it is filling a fair value gap. Beautiful. Now note how this fair value gap held price. Did you see any close above this fair value gap? No. See just the bodies. Although this candle here wicked through, I still will call it mohawk. This wick that you can see above this fair value gap. But if you notice, no candle closed above this fair value gap. This fair value gap held price. So when you start seeing price finding it difficult to go above or close above a fair value gap, it's telling that this fair value gap is holding price. I don't know if you understand. So this is how you read price and to come to you the experience. So now you can see something here again. There's another fair value gap here. So I want to see price close above it. I don't want to see it hold price, because when institutional order flow is bearish, you want to see institutional levels give way for price. You don't want to see other blocks holding price. You don't want to see fair value gap holding price. You want to see how you want to see price pierce through it easily. I hope you understand. So I'm monitoring how price moves or reacts in this level here. That's what I do when I trade. Then you can see this low here. I will draw it out again. You want to see price break through it with ease, like hot knife through butter. So at this point, these are intermediate time high. I don't want to see price go above this high. Now, because I understand price action, I can move my stop to this point here. This is to reduce risks. I'm not bringing down my stop here because of fear. I'm bringing because I understand price action. If price should get to this point, I don't want to be in this trade again. This is a 1 minute time frame, mind you. And then you can see that on a 5 minute or 3 minutes, let's go down to a 5 minutes. We go up to a 5 minutes. You see that this could only just be a retracement. So I may be wrong. So if price gets to this point here, I don't want to be in this trade. I don't want to be in a trade where price has moved high, retraced, moved. Even if it keeps going down, I don't want to be in that type of trade. So I hope you understand. So you can see it looks like price seems to be finding support in this fair value gap. But it usually happens like this. What I expect now is I want price to break this low, then return back to this fair value gap and use it as a resistance. So it's a support, breakthrough, resistance, something like this. It usually happens like that, and it's called inversion fair value gap. So a fair value gap is supposed to hold price, like you see here, for it to rally upwards. But once it breaks through it, when returning back to it, it uses it as a resistance to continue downwards. So I hope to see price break this low. So let's watch. All right. If this does not hold price, I'm out.